All right, so we're going to start on chapter 7M. This is the first study. This is most brilliant piece of work, Wyckoff's most brilliant piece of work. Uh, Not only just according to myself, but others as well who understand this material. So, why is it so important that this work is understood and analyzed? It's because it has key concepts in it. All right, what are those concepts? And you'll see how I get into all the details. All right, so the first is what you really want to pay attention to is the importance of climaxes. Believe me, this is probably the thing that Wyckoff looks for. Um, one of the uh, starting points, I would say, is these climaxes. In fact, this study starts off with a climax, and that is not by coincidence. There is a reason for that. So the importance of climaxes and then the secondary tests, which create the springboard. So you'll understand, the learning objective here. Let me write this down. What is a learning objective? Learning objectives for this study include climaxes and how important they are in terms of taking a position, in terms of seeing a move culminate, meaning end, and a new trend start. So these are the boundaries of trends. This is when a trend is scoped out, the beginning and the end of a trend, you're going to be looking for climaxes. The beginning and the end of swings, you're going to be looking for climaxes. Climax frame the trend, climax frame the swing, climax are the beginning and the end. That's why they call it ending action, but it's also the beginning of one trend is the end of another, right? So whatever. So anyway, point here is really, learning about climaxes and then incorporating that into your analysis and trading. Second is key learning objective is the springboard. What else? It also talks about absorption. And when I talk about climaxes, and I want to harp on this, I'm talking about ones that end the trend, and B, the minor climax, and the swing. All right. So there's a difference between climax and minor climax. Minor climax terminate the swing. Major climax terminate the trend of the time frame that you're looking at. All right. So we'll go through all of that. What else? Let me think. The springboard. Oh yeah, the signals. What are the Wyckoff signals? So he calls them the opportunities for entry. So opportunities for entering. You'll go. These are the quote unquote signals, right? If you want to put in that term, what are the signals? So the learning objective will include all of this, and I'll explain all of that. Let me think what else. Let's see. Oh, yeah, very important. You're gonna learn how you're gonna learn how trends break. Trend break. The point where distribution is going to be occurring, what are the signs of distribution and how it breaks. So evidences of distribution characteristics. You'll learn about that. And let me think, what else? Okay, so all right, so this is the learning objectives, okay? So put that somewhere. All right, now the way you study this material is, I'm trying to show this to the community here because you cannot just read it. It doesn't work like that. It's very complicated, but there is a way to learn it. So go to the what the hell is the damn chart? Damn. Yeah, by the way, this is the longest study, as you can see. as I'm scrolling down and down like a. Anyway, so somewhere here, there it is. All right. So we're going to flip this and I'll show you how to learn the material. You learn it by, you take the snapshot, right? All right. So file, known save, and oh shit, ruler. I gotta do it again. Take a snapshot. All right. Oh, I got it. I got the volume. Okay, good. Oh yeah. So another learning objective is how to read the volume. You learned that as well. And finally, key things, key attributes of bars in terms of shortening of the thrust and clustered closes, where the net change is 0 between a number of closes and how to interpret that. So I don't want to say I'm an expert at certain things here, but I can definitely teach them. And anyway, I have to find the, go back. There we go. Okay, so now I'm going to go through this. The way I'm going to do this is first, I'm just going to cover the uptrend piece. That's it. And then the next part, I'm going to cover the break up to the initial break. And then after that, the downtrend. Okay, because it's a very long study and pretty complicated. All right, so I'm going to break it down and you're going to see how I'm doing it. Now, if you want to learn, and this is why I'm doing this for community, all you need to do is the same thing I'm doing, right? And that's it. All right, so let's continue with this. All right, as previously explained, blah, 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 the most important thing to know about the market is the trend. Again, the most important thing to know about the market is the trend. Why? Because you got to know it. All right, why? Because the line of least resistance. Why? Because there's a bias to the upside, so it's in an uptrend, which means it's easier to go up. And there are other reasons too, but we'll just stick to this. All right, we study our daily trend chart. All right, so no one, okay, the next paragraph here talks about, oh, you know, should I study the ES or the SPY or the NQ or the Dow or the S&P mid cap or the S&P this? There is no perfect average. All right, so you can study the ES or you can study the SPY. There is one point though. On the SPY, I've noticed many times the volume is very, for lack of a better word, Wyckoфfian. Better than the ES, although one is just a futures market of the same index. The SPY is very, after this study, if you take a look at the SPY, somehow those volume principles, they stick out more, much more, like much more than the futures. I mean, that's just a note thing I have seen. But anyway, you know, folks may not think that, but you're going to see if you take a look at the SPY, you take a look at the ES, you take a look at others, the SPY is more of, the volume sticks out more. That's what I'm trying to say. All right. Okay. I know. Okay. So this whole paragraph is, you know, nobody has a perfect average, so just pick one. So up to you. You need to pick one. Okay. Whatever. And basically, you should just pick the one you're already looking at. Don't make it rocket science. All right. And you're going to start observing it. Okay. And you'll exercise judgment at all times, and you should be like taking a look at your group charts or position sheet and your charts of individual stocks. All right, so I mean, I'm not going to go into all that. We're not going to be taking a look at all the group charts and all that. If you want to do it, fine, do it. But the thing is, there's something called inductive and deductive thinking, all right, which is top down and bottom up. So top down, like top down analysis is like, all the different time frames. In here, what he's referring to is taking a look at the SPY, which is the top, and then down, which is looking at the groups. Okay, and then bottom up, stocks, the individual stocks, and then the groups, then the sectors, and then the overall market, like the SPY index. So it's top down and there's bottom up. So he says that to make good judgment, what he's implying here, you should see both top down and bottom up, not just take a look at an index. Just looking at the SPY, you'll have very limited view. Taking a look at one high level overall index when in fact leaders may be breaking down, sectors may be breaking down, groups may be breaking down. You see what I mean? All right. So let's just continue. All right, here it is. Here's how you start. Over here, we use the period of December 8th to December 17th. Just 1 second. 1 second. Okay, so we're going from left to right. I'm using this ruler to go left to right so we can observe bar by bar what's happening. Okay, and on the left-hand side, I'm just using the ruler to point out the line that I'm referring to. So you see the line that I'm referring to on the left-hand side and the chart behavior associated with the sentence or the line in the PDF here. All right, so we use the period December 8th to December 17th as our starting point. What does he use? December 8th is this bar to December 17th. Okay, so this piece right here. All right, so as you can see, this is the leg that he's analyzing. The story by the chart is as follows. We use the period from up to the December 17th, from the 8th to 17th as a starting point. This interval of 9 days marks a sharp acceleration of the previous major decline, culminating in widespread and daily price range and very marked expansion in the volume. So what is he saying? He's saying, look, you got big range and big volume. Look at that. See that volume expansion? And you see the ranges on these bars, how they're going from little to bigger, right? And in the volume trading, as the market reached its low point, thus reflecting panic selling, which takes place under such conditions. So what is this big bar? It is panic selling. That is, how do you know it's panic selling? Because of the widespread and wide volume at the bottom. All right, so panic selling is also another term for climactic action. And also, it also implies that the other side is taking, getting good prices. All right, so the volume on the 8th was around 2 million, and this increased to 5 million on the low point. So in this leg, here you have about 2 million, right? 2 million, I think that's 2. Yeah, 2 million. And over here you have about what? 5 million. So you can see the market marked expansion in volume, meaning more than double from the start of the leg of the swing to the end of the leg of the swing. All right. Okay, now here's the point here. Tape observers would have noted the fact that large part of this volume, what volume? The 5 million volume on that day low. How did it come in? Did it come from the top to bottom or bottom to top? And he's saying that most of the volume, a large part of this volume occurred as the market recorded the extreme low and on the rally from the lows. So this is what? Your volume of the bottom. Dig it? This is your volume off the bottom. What does it mean? It means that as the market went down, someone was buying low. They bought from low to high, and a majority of this volume is not on the way down, but from the down to the top of the bar. All right. What this now, here's the key word here, confirms. See this? This confirms the fact that the climax of the down movement has been passed. It's a very important line because it indicates that on this bar, the climax has ended. So what is he saying? The volume from the bottom to the top is ending the climax. All right, so we're going to write that down. So right here, climax ends, VOB ends CMX, which is your climax. Ends, what is this? VOB ends the climax. Okay? Now, again, what is mentioned here is the word confirm. This is a very important word, folks. All right, because we're always looking for confirmation before we enter the market. So this is the first time he mentions this word confirm. All right, now it gives us the starting point of our next forecast. So the word forecast, okay, so what does that mean? Climax has passed and volume off the bottom. So it's very important. Okay, now what else is he saying? He said if you had an intraday wave chart, would show the details of this tape action, including feverish activity around the day low point. I mean, obviously, if you take a look at this bar, it's a bar with big volume, right? And yes, the high-end close tells you something. But when you examine inside the bar on lower time frames, you would see on a wave chart that there's high volume off the bottom. All right. All right. So we must now assume, in view of the above, that the trend is tentatively up. Again, what is important here? When you have a climax and that is followed by volume off the bottom, it confirms something. It confirms that the trend is tentatively up. Okay? But there's additional confirmations. What confirmation? Higher low. And then after that, the final confirmation is the higher high. So there are three things. One is the volume of the bottom after climactic low is telling you that tentatively the trend is up and the climax has passed. So if you're asked the question, how would you know that a climax has passed? How would you know the down move has ended, at least tentatively? The answer is the volume of the bottom. Very heavy rally up. On a lower time frame, it would look like a rally. It would be a very strong rally on a lower time frame. Okay, so on a higher time frame, we would see a climax. On a lower time frame, right after that climax, after that extreme low, would be a high volume rally that shows strength. And when you couple a climax with that volume off the bottom, you can say, at least tentatively, that the trend right now is up, and this is subject to additional confirmation, and the climax has ended. How has the climax ended? It has ended by way of volume off the bottom. All right. Now, we're looking for, here's the thing, when he mentions confirmation, this is This is confirming that the climax has ended. Okay, so let's not get it twisted and say the trend has been confirmed. What is being confirmed is the climax has ended. Okay, what is the first confirmation here? That the climax has passed, not confirming that the uptrend has been established. So what has been confirmed? Climax has ended. Has it been confirmed that the trend is up? No. All right. So in view of the trend is tentatively up, which is not the same as confirming, because it is subject to confirmation by higher supports on the next reaction. Okay, so what does it mean? He's basically looking for a test. All right, that's all it is. Now, I'm not going to go through all of this, although it's extremely important, these footnotes. All right. Oh, boy. So, I mean, these are just three reasons why this happens, why you have a climax with volume off the bottom. One reason is, all right, short covering. The second thing is maybe it's just temporary. Temporarily, the climax has ended and they're going to sell on the next bounce. All right, so market moves down and then you have volume off the bottom, confirming the trend, the climax has ended. Does that mean the downtrend has ended? No. What that means is that volume off the bottom after the climax occurred could be short covering. It could also be a temporary pause to create a counter trend rally up or a swing up to test higher levels. And at that point, additional selling will come in on the bounce to continue the downtrend lower. All right. What happens typically after a climax? A technical rally. For some reason, it's called the automatic rally. You heard of it. Okay, selling climax, automatic rally, secondary test. The words that Wyckoff used was technical rally, as indicated right here. All right, meaning you have a climax. What happens after that? Technical rally. All right. Here it is, technical rebound, which customarily follows a selling climax. That's your quote unquote automatic rally. And what do you do if that climax was temporary? They're going to sell the automatic rally or the technical rebound or the technical rally. All right. So what is he looking for to figure out? Okay, is this temporary, or are we in a position to shift direction and create an uptrend? What he's looking for is for the secondary test to do two things. One, all right, the secondary reaction after the technical rally, which is automatic rally, should hold around or above the climax lows. He wants the secondary test to make a higher low, all right, above or around the climax low, while the volume shrinks appreciably. All right, so the secondary test is looking for a low volume secondary test, which either is a higher low or just around that climactic low. All right, with significantly less volume. Now there isn't a way to quantify how much is significantly less volume. but it should be significantly less and it would be obvious, and you have to make a judgment call. So for example, this leg, you see this uptrending volume. When the next secondary text when the secondary test occurs, the volume should have a decreasing trend line. So you see how this trend line is increasing on the climax. Now when you see the secondary test occur, and I was to draw a trend line on top of the volume, it should be a decreasing trend line, and that would be one way to recognize it. Okay. Now here's very important. Okay, should the secondary test occur after the technical rally above and prices hold on or above the climax lows, while volume shrinks appreciably, we have an indication. Very important indication here. What is the indication? That liquidation has completed and support is coming into the market. So on the secondary test, it is an indicator. It is an indication. What is it? Indication of the next important move. So that secondary test is an indication of the next important move. And B, it is an indication that liquidation has completed and support is being established. In this connection, it should be noted that the same principles apply which apply to large swings. All right, this is very important. In this connection, whatever that means, it should be noted that the same principles of what? Climax, automatic rally, secondary test, that holds with lessening volume. Those principles, climax following by volume off the bottom, then the automatic rally, then the secondary low volume test, that holds. What about it? This same principles or sequence of actions, what is it doing? What is it applied to? Yes, it's applied to the daily, but it applies to the large swings and also applies to smaller moves. Swing trading, meaning the swings up and down, like the swing high and the swing low. It applies to that and to the day-to-day buying and selling waves. All he's saying is that these principles are universally applicable across higher and lower time frames. That's it. Apply on the daily. They apply on a daily trend. They apply on the daily swing. They apply on an hourly swing, swing up, swing down. They apply on a 5-minute chart, on a 5-minute trend, and a 5-minute swings. So thus a careful examination of a trend and group charts of individual stocks over a period of time will reveal numerous examples of the above phenomena. Basically the above principles of what? Climax, volume off the bottom, technical rally, secondary test, low volume, secondary test, all indicating what? That the climax has ended. What is the indication that the climax has ended? The volume off the bottom. What is the indication that that support is coming in? The secondary test. What is the secondary test? It occurs after a climax. What is the climax? It's widespread, wide volume at the low. All right. So all right. So but you gotta apply. You gotta allow variations. Why? Because sometimes the climax is at the low, and sometimes they're follow-through bars, meaning it's not at the low. Meaning you could have another swing following the climax that goes lower. The climax does not need to be the extreme low or the extreme high. You can have the market going beyond the climax. All right. So this is what all of this is about. And here's the example. For example, abnormal volume may last either 1 or several days. Okay, so yes, you can have a very high volume bar, but you can also have a series of high volume bars. Understand? And here you go. Selling climax may be completed in 1 day or be completed in a number of days. And volume may reach unusual proportions on the day of the low point or some days ahead of the final low. What does that mean? Well, this bar, for example, may have high volume indicating the climax, and then we have a couple of more lower low bars where the volume diminishes. This bar is still the climax, um, even though there are additional lower low bars. Okay, that's what it means when he says the low point is made some days ahead of the final lowest low bar. All right. Okay, so I've gone through those principles, and believe me, I see this shit all the time. Like I've seen it even on Renko charts, where I see that volume off the top and volume off the bottom, and climactic action, and a hinge, and a little secondary test, or an upthrust, or a spring, and then basically a trend change. So this happens. Anyway, where was I? On the other hand, okay, so evidence that liquidation was not completed and that support turned the market upward on the 17 has been withdrawn. Okay, this happens if on the secondary test the market does not hold and breaks through. What does that mean? Liquidation is not completed. Support was fake. All right, this is in two situations. One, the secondary test does not hold the low. They're not holding, right? Meaning the volume doesn't appreciably shrink. In this case, it does. How do you know? Just draw the trend line. See? Trend line. Bang. Right there. This is volume going up on the secondary test, volume going down. So, and it's holding. What does that mean? It means it passed the secondary test. What else does it mean? It means liquidation has completed. However, if on the automatic rally there's heavy selling, it will break the low, and that obviously means that liquidation is not complete and they have more to sell, and they take the price lower. So when do we know that demand is beginning to overcome supply? Well, if buying support comes in around at a higher level, we may conclude that demand is beginning to overcome supply. Okay, so there's a couple of things I want to say here. One, on the secondary test, the volume is decreasing. So when you compare the first leg down with the climax, it's high volume. When you compare this first leg to the second leg down, it's less volume. So you're comparing the down waves. You're comparing this down wave to that down wave, the first down climactic wave to the second climactic wave, and notice the appreciably decrease in volume. But understand that between the first down wave and the second down wave, we have volume off the bottom, meaning the biggest volume there is coming from the bottom to the top. What is that evidence of? Demand. Now, when you take that demand and then compare it to the secondary test, you will notice that the bars in secondary test have much less volume. What does this mean? This means that you are comparing two things. One, the secondary test to the climactic wave down, and two, the demand that has come in to the following pullback, which has less volume. So the demand volume on the top on this rally here compared to the pullback volume, as well as the climactic volume here on this initial leg to the secondary test. So you're comparing supply to supply and demand to supply, meaning down wave to down wave and up wave to down wave. All right. Okay. So on January 3rd, these averages rise above 152, which gives final confirmation of an upward swing, which may become substantial. So what is the final confirmation of? Is it a confirmation of climax? No. Is it a confirmation of what? It is a confirmation of trend. When does that happen? On January 3rd. What happens on January 3rd? Higher high. So we're going to just write that down over here. Higher high is your trend confirmation. Okay. So I know he uses the word confirmation a couple of times because different things are being confirmed. The first, what's being confirmed is that the climax has passed. This does this in so confirm. Let's take two things. One is the confirmation of trend, and the other is the confirmation that the climax has ended. So here, the volume of the bottom is confirming the climax has ended. All right. Here, the low volume test with the demand in the background and the prior climax. What is that confirming? It is confirming that liquidation is complete. Okay, so that's the second confirmation. The third is the higher high, which is confirming uptrend, the beginning, the establishment of an uptrend by way of higher lows and higher highs after climactic action, demand in the form of volume of the bottom, and a higher low with less volume indicating that liquidation is complete. And then after that, the higher high will then confirm the establishment of an uptrend. The other thing I want to point out here, do you see an extensive schematic? Like when he mentions this, all the confirmation and this, do you see any extensive phase A, B, C, D? Do you see all that spring and a sign of strength and more important sign of strength and all that? No. It's just a climax, demand, secondary test, boom. It's not a long drawn out range with all the fancy stuff. And it's really important to mention. I'm not saying that I'm anti schematic, but I'm saying that the schematic is a model that includes a lot of different behaviors. The error in following the schematic is when you follow it sequentially, looking for every single thing in the schematic to be on the chart. That is the error that most folks make. They look for upthrust and then the upthrust after distribution called a UTAD or whatever. There's no such thing. I mean, there is, but to force it on the chart when is weird. Okay, these are white. This is what Wyckoff is teaching, and what's out there in online and all is totally something else because its intent of the schematic was to create a model with all of the little pieces as a teaching aid. But what happened is that it's being created into a pattern, which is then being applied on markets in a very sequential way, almost like a checklist. This. So that's the error. Anyway, coming back to this. On January 3rd, they go above and create final confirmation. All right, good. Okay, so now what we need to do is, in taking a position in the market, these are the Wyckoff signals. We have three signals or three opportunities to go long. What are the three opportunities to go long? What are the three buy signals? You're going to learn that right now. All right. So in December 17th, when the market gave indication of completing a selling climax, all the way here on the climax right here, right? When it's completed the selling climax, how is it completed selling climax? Why? You have volume off the bottom from the climactic low. That gives an indication that the climax has ended. That's how it ended. that is a buy opportunity. Okay, that is uh, that is the best or the lowest price. Okay, that's how you buy the low, by the way, by looking for the climax volume off the bottom and intraday tests. Different story, but that's what buying low. That's how it's done. All right. So what was it? All right. At the same time, as shown by entry and vertical chart, that you see the was able to rally vigorously on increasing volume. So that rally, that vigorous rally, which I'm calling volume off the bottom, that occurred after the climactic low, is telling you this is your first buy entry. Okay. So this was the first time it had shown ability to rally aggressively, and the first time increasing volume had been shown on an advance for some time past. Now look at the words first time and first time you add price and volume from the bottom. What is that? That is your change of behavior, which is also known as change of character, which is also known as sign of strength. The first time that you have a high volume, big rally after a climactic low is your change of behavior. And what Wyckoff is saying here is that is when you go long. How do you do that? You look for that change of behavior after the market is exhausted and has climaxed, and that I would wait on an intraday basis for that change of behavior to occur, the secondary tests to occur. There on the secondary test, you will see your lack of supply, also known as last point of support or something, but it's basically just a lack of supply on an intraday basis after that change of behavior and attempt to get in at the lows. The first time, this is key word here for your change of behavior. What is the behavior? Big price move and big volume, as opposed to before where demand was weak. Now it is strong because of a big price move and very heavy big volume. There, your behavior, price volume behavior has changed. On the basis of these tentatively bullish indications, we are justified in establishing long positions if we can get near the lows when we place our stop orders, all right, on the commitment 2 or 3 points under the purchase price. It's very important because, as you know, it can dip a little bit lower. So he putting his first entry, his stop, 2 points below the low. What is the low? It's about 135. What would he put it at? Around 133. All right. So he put it 1.5 or 2 points under the danger level. What is the danger level? That's the climactic low. Climactic low is 135. Where is he going to put it? 130, around 133. Okay, so that's one. That's the buying opportunity. Second buy opportunity. What is the second buy opportunity? Second buy opportunity is on the low volume test, which confirms what? Confirms that liquidation is complete. Our next buy opportunity is on the 29th when the market completes 3 days of lower support, but the closing price on each of these days are between 140 and 141. So what did he know? The closes. The closes. What about the closes? They are clustered. Where are they? They are right here. What's the difference between close to close to close? Not a lot. What is the net change between close to close to close? Almost nothing. They're almost unchanged. So what is he saying? He's saying when on that secondary test, you see 3 days of low support, but the closes are unchanged. They are all between 140 and 141. That is giving you an indication. What are the closes, clustered closes, telling you? It is telling you that the selling pressure is losing its force, and the net result of these 3 days pulling and hauling is to leave the average almost unchanged. What does that mean? 3 days, no movement. It's stuck. There's no net change. All right. leaving the average almost unchanged after a considerable reaction. So he's taking a look at the closes. It's not just the volume, but on the bars themselves, he's taking a look at the closes and noting they are clustered. What is the clustered closes telling him? Lack of selling pressure. All right. All right. What else is he coupling that information with? Low volume. So low volume is the volume indication. The price indication is clustered closes. Putting them two together, the inference is that there is a lack of supply. Supply is losing its force. It's gone. It's evaporated. And what does that mean? That means that the secondary test has completed. And now you have a broad range of support. All right, so it's not just a one bar support. There's a number of bars here. So that creates a support line or zone. Again, the word support and resistance came from Wyckoff. And the word zone, where you hear selling zone or supply zone or whatever thing that's on YouTube, the word zone is also from Wyckoff. Right here, zone. When they say buy zone, sell zone, say support, where did it all come from? First recovery, we either buy on the reaction if we missed. So if you missed the initial buy, this is the second place to buy. You can buy on this reaction if we missed our opportunity or add to the holdings. Basically pyramid right here, or just enter here. And as before, what is the low? The December 17th low. If you're buying here, where's the danger point? Right below here. Why is that the danger point? Because if it breaks that low after making a higher low, it can lead to additional liquidation. The whole point of this secondary test on low volume is that liquidation is complete. That is what this is confirming. So if it breaks this low, it means the liquidation is not complete. The average is now on the springboard. So this is the concept of the springboard. What is the concept of the springboard? When you have a climax, then you have volume off the bottom, leading to a strong rally, followed by a low volume test, which is holding the lows, and is over here a higher low with less volume, with less price action, that is broadening the range of support. It is creating your springboard. That springboard is right here. And at that point, if you're in or going to get in, your stop should be under the climactic low. So climax, secondary test, the indication of liquidation being completed equals springboard. All right, final area to go long. On January 3rd, when it makes the higher high. So when it makes the higher high, what do we call that? Well, today, this would be a break. This is your evidence. What is it evidence of? It's evidence that this guy is saying buy the breakout. Wyckoff here, where it says the average goes into new high ground, overcoming new highs, just like new lows, overcoming the previous tops, What is that? That's a breakout. And volume tends to increase on the rally days. December 30th to January 3rd, the indication is characteristic of bullish trend. However, this is the least favorable to buy out of the three opportunities. Why? Because you're buying on the up wave instead of the down wave, which does what? It increases your risk. Okay? So the breakout signal, this is the breakout. He's saying, Wyckoff is saying here, buy the breakout. However, the breakout is more risky because you have more risk. So right here, the first signal to enter was when there was a climax volume off the bottom on an intraday basis. You can see that the climax has ended, volume comes in, you go long. But the way that's practically done is when that climax comes in and you have the volume off the bottom, creating that technical rally or that change of character, that change of behavior, the first time that price and volume is that heavy, what you do is you wait for the secondary, you wait for the pullback. If that pullback has low volume on it, it is an indication that it's going to fly. You may also just wait for a higher high on an intraday basis, and that was also confirmation that it's going to go. So that's how that's done here. Here it's just a secondary test. So I mean, as you know, the markets they tend to rally and they pull back and test, right? And that's what they do. So that's the best. That really is the best place to get in. Why? Because if you get in over here, right, what happens typically is the market will come back and stop you out as you're trailing the stop and you're pissed off. All right. So a lot of times when the volume of the bottom and heavy whatever comes in and it rallies, you can get in on the pullback or the test of that area. This is what this is doing. It is testing. Okay. Similar to springs. When you have spring, right? What happens? A lot of times the spring gets tested, then the market flies. Or the upthrust gets retested and then the market flies down. So the climax, you have that heavy buying, don't for a second think you're not going to have a test, because you will. And those tests are actually the best place to get in. Why? Because it's after the test that you have this massive move. If you go long here, chances are, let's say you go long right here, right? Guess what? The market goes to your break even. It rally, come back, pull back, break even, it'll stop you out. When you have zero, and then what happens? It flies. So that's why whenever you have heavy demand for whatever reason, don't for a second think that it's not going to get tested. I don't know if it's 50%, but many, many times, price will just go back to that level and test. If you see gold, same shit. If you see whatever, same thing happens. So it's those tests that are even more important. All right. Why are they important? Because they have that's when the real move launches. And also, like, from another perspective, what, from the quote unquote mitigation perspective, the market rallies, pull back, close out their sells, right? And then it's ready to fly. So, all right, well, let's go back here. All right, so now what we have, this is the breakout signal. So he was all for breakouts, just not really because of the risk. But this is a breakout signal, and he mentions it right here: new high, new ground, taking out resistance, boom, buying on the up wave. This is all breakout right here. I remember that we now study the average. All right, whatever. It is impractical for us to operate in all 50 stocks, but you can do that now by looking at ETFs like SPY or the ES. All right, so all he's saying right now is buy the best breed. Which ones are you going to buy? The ones with the most relative strength. He called it here technical strength, but you know what that means. It's relative strength. So which ones stocks are going to look for when the market is in a confirmed uptrend are the ones with the most relative strength. And how do you know? You turn to your group averages. What do you do then? You look at the ones with the that are strongest. Remember, this is top down right now. Okay, so you want that group strength on your side, right? You don't want to get in a strong stock with a weak group. There's a conflict there. Having decided that the trend of the market is upward, we must therefore continue to trade on the long side until there are indications of a change in trend, or until the trend is in doubt. We must always be on guard against such changes, and when the trend is in doubt, we take a neutral position. For the next several days, the market makes further progress on the bull side, and we observe that the close on the 6th, 7th, 8th, 9th, and 10th are all within the range of 1 point. Where is the 6th, 7th, 8th, 9th, 10th? It's right here. What's happening? Their closes are clustered. What does that mean? They're making no upside progress in 4 days. What does that mean? Well, let's take a look at the volume. As as the closes are clustered, the volume is tapering off. What does that mean? The volume is slowly decreasing. All right, it's tapering off, which may mean a lessening of demand at the top of a swing. Here we have a way of judging the top of a swing. What are some of the indications you see at the top of the swing? Some of the indications that you see at the top of a swing are clustered closes and declining volume. What is that? That is when the closes are not making any net progress and the volume decreases. When that happens, does that mean that the market is going to reverse? No, there are other indications you want to see to determine whether that swing is about to terminate, especially when it's quote unquote grinding on low volume and not making any progress. Let's get into that. The conclusion is partly confirmed by the shortening of the upward thrust from the 3rd to the 7th. Again, there are three indications that he's mentioned here, one being clustered closes, two being lessening of volume, three being a shortening of the thrust. How is he gauging the shortening of the thrust? He's looking at the bars and looking at the high to the next high to the next high, and noting that the high from one bar to the next is small. The distance between one bar is high and the next bar is high and the next bar is high is little. It's shortening the thrust, shortening the distance from high to high of these sequential bars. Take that indication. Take that the closes are clustered. Take that there is low volume. And together that is painting the picture that there is a lack of demand. If demand was there, the thrust would not be shortening, volume would not be small, it would not be tapering off, and the closes would not be clustered, meaning progress would be made, net change from day to day to day. All right, now here's the point. Right here is when the lack of demand on the upswing is now being followed by a climax, which terminates the upswing right after the lack of demand has been identified in the swing. And it is this bar right here, right there, where you have a sudden increase in volume. Whereas he says here, on this day, the volume increases abruptly, suddenly, all of a sudden, abruptly, compared with the volume in the preceding sessions, which was quote unquote tapering off. At the same time, the price runs up to a near new high, only to close low end and actually below the previous session. Close is less than the prior close, close low end, and high volume. What does that mean? Volume off the top, supply pressure, climactic action. All of the foregoing is evidence of the approach of a corrective reaction, but we still hold our long positions. Why? Because the trend hasn't changed. The swing, however, is done, meaning the upswing is over. We're going to have to endure the pullback. The pullback is starting. What started the pullback? Minor climax. How did the minor climax come about? It came about as a result of a lack of demand. How was the lack of demand identified? It was identified by three indications. One, clustered closes on a series of bars, shortening of the thrust on a series of bars, and tapering or lessening volume on a series of bars. When that lack of demand was evident, it was followed by a minor climax, which was abrupt volume on a bar that went to a higher high and closed low end, and that terminated the swing. It's a very important thing to note because these swings happen all the time in different markets. And now you are able to analyze the tops and bottoms of those swings to trade. Looking for what? Climax. What kind of climax? A minor climax at the top and bottom of a swing. What is it saying? It's saying a reaction is about to ensue. Is he going to hold it long? Yes, he is. Why? Because it's not a change of trend. It's a rotation, meaning it's the start of a pullback. And here you go. The action on the 9th, which is the climax, is an illustration of a typical buying climax. Not my words, his. Those who think that climaxes only occur on trend high and low, take a look at what the words say here. The action on the 9th. What is the 9th? Right here at the top of a swing, not at the top of a trend, the top of a swing, is an illustration of a typical buying climax. There's the words, which is the reverse of a selling climax. On this day, a poor quality of demand is being promptly overwhelmed by a superior force of supply of good quality. In other words, the bulls realizing they are encountering resistance. They're encountering resistance. They're also encountering a lack of demand to the advance. Break the stalemate of the 6 to 8 by bidding up prices to attract those buyers, quote unquote, inducement, induce the breakout buyers even more, who were too timid to come in before, but now fear that it's making a new high. Let me get in. FOMO is driving me to buy the high. So they create that FOMO and dump their positions and cause a pullback. Thus, operators their opportunity to dump part of their lines on this broad and active buying wave made to order for that purpose. What does it mean? It means that they are creating this up move, aka manipulation, to sell to breakout buyers. That's what it means. All right. I think I'm going to stop right here. And I'll continue tomorrow. All right. Thanks. Bye.